Okay, everyone, talking here to Andy Hill, fellow mortgage broker, definite thought leader. You want to hear what he has to say. Andy, finally, after 4 years, we have a variable rate decrease by 0.25. People are celebrating. Now they're wondering, when's the next announcement? July 24th? Are things going to go down? And what about after that? So let's hold horses and firstly talk about what made them cut this rate finally and what's going to make them cut more leading to July 24th and other future dates. Andy, welcome, by the way.
Yeah, thanks for having me. Yeah, we had a lot of back and forth in between the prior meeting and this meeting for all that watched the Edmonton Vancouver series. Similar amount of back and forth. At one point, we were pretty sure that the bank was not going to cut in June, but at the last minute, we saw a really surprising GDP print for Canada come in quite a bit lower than what the market was anticipating, as well as the inflation data kind of came in around what was expected, maybe just like a little bit lower. For Q2, they were expecting 2.9 and it came in at 2.7. So that kind of gave them the door to do their first rate cut. Exciting stuff. It's the start, but you know how quickly these rates come down is going to be a continual sort of meeting to meeting narrative that gets shaped over the next 6 months, with 4 or 5 meetings thrown in there.
I got it. So GDP needs to start trending towards the 2% goal. You said at 2.7, so we're in the sweet spot, I believe. So if it stays at 2.7 or it goes down 2.6, I presume that's a good thing and could lead to more
Yeah.
cuts. To make sure I'm clear there, GDP needs to stay weak for a little while.
Yeah.
And then also we got the U.S. Feds announcing their announcement June 12th, Eurozone June 6th. Australia June 18th, and England June 20th. They may follow us or have their own narrative, but how do those other banks, and assuming they also decrease, does that fuel the fire to help us decrease? Does that have a bigger impact for the market? Let's talk about that.
Yeah, I mean, at some point in time, we may experience a shock. Everything right now is being uh, constructed in a soft landing sense. Over the next few months, as these other central banks speak and meet and change their interest rates, we're going to start to see if there's more strain than is being currently priced into the market. So if those banks kind of continue to cut, but slowly, then that will probably open the door for Canada to continue to cut, but slowly. If one of those central banks starts to talk about shocks in the system and they have to cut more aggressively, that will probably open the door for all central banks, probably including the Fed, to start cutting aggressively to try to stem the tide of any sort of like bad bounce off of this stressed world that we're living in right now.
Makes a lot of sense. And yeah, lots to be determined, but it's positive summer momentum. And of course, this is going to have an effect on potentially the bond market. And actually, most people right now, especially if they've just had an accepted offer, everyone's going 3-year fixed. So I guess one question is, should they consider 5-year variable? More importantly, I think a lot of people who are in fixed and probably aren't going to change that, they're wondering, does this mean the fixed rates are going to go down? And can I ask my broker to negotiate the rate further? How does the variable decrease from today affect the bond market? How has it affected it as of today? What's your prediction? And then ultimately, I think we'll finish off with fixed over variable. What do we think?
Yeah. So with that like big back and forth we had kind of between, just looking at some charts over here, but kind of between the end of last year and the beginning and up until now, fixed rates have kind of traded in a range, and they've kind of gone up and down a little bit throughout the course of time by 30, 40 basis points kind of influx. Today, and actually this week, has been the start of those rates kind of normalizing a little closer to the bottom end of that, kind of where we saw rates at the end of last year. So if you locked in a rate, say 2 weeks ago, there's probably a pretty good chance that you could see somewhere in the realm of 10 to 15 basis points off of that rate today. And that's maybe more at like a treasury discount space. We'll start to see if lenders reprice some of their rates with this kind of new range of kind of yields that we're trading in right now. So for us to really see a massive change to rates, we kind of have to be about 40 basis points lower than we are today on maybe like the 5-year and the 3-year. At that point, you're going to start seeing like 4s in front of everything.
So we want people to Google bond yields Canada. There's usually 3 of them, 3, 5, and a 10-year bond yield. And you're saying if we look at the one that says 3-year and 5-year, if those go down by 0.4, more than where they are at right now, and maybe you have the number in front of you, that is a trigger point to tell the broker or bank, hey, I know your margins are better, lower my rate.
Yeah, and to be honest, I think right now we will see those treasury discounts very like a lot better than we did last week.
Right. And to clarify, treasury discounts are when brokers can talk to the lender, talk to their treasury department, which allows discretionary discounts, usually only for some of the top brokers. They'll be more generous, right? So it's still up to the broker to negotiate this, but because there's more margin, they'll be more generous there. But it still is up to the broker to do the nudge, or else no one can proactively do it. Of course not, right? Just to clarify, right?
Yeah, we probably won't see a lot of changes to the posted rates just yet. But in the event that we do see kind of that 30, 40 basis point, 0.3, 0.4 decrease to where those yields are today, so the 5 years trading at like 5.4 or 3.4, if that starts to trade around 3% or less, that's going to really fuel like a big drop in posted rates, which means penalties will go up.
Right.
And
interest rate differential.
And advertised rates will be, most likely all with 4% X or 4.X%.
Got it. No, lovely. And then maybe just a bit of like just zooming out again. When you talk about even just like a soft landing, like remind our audience what that actually means here, and then we'll wrap up whether you think a 5-year variable or a 3-year fix is the better bet right now.
Yeah. So in the pandemic, or after the pandemic, after the lockdown and all of that, there was so much money created through governments, through low interest rates, that the economy was running at 150%. That was really stimulated by what the central banks kind of fueled through that cycle. And then, what we had was this large inflation kind of push from that overheating of the economy. And the goal of higher interest rates is to kind of like throw some water on that fire. And so all the central banks throughout the world have been trying to kind of quell that overheated economy with the higher interest rates, higher debt servicing costs, and all of those sorts of things. What can happen, similarly to what happened after the pandemic is that you can find yourself in a situation where you've gone too far, you held things too tight, and something breaks. And in the event that something breaks, the whole system starts to kind of collapse a bit into itself. I mean, we had like 2008, we had European crisis in 2011 to kind of 2014 or 2015. You had like kind of the pandemic crisis as well. So they really don't want to see another shock to the system. They really just want to see things be able to absorb these rates. The economy continues to work. And so that would be kind of the definition of a soft landing, whereby everything stays pretty status quo, nothing breaks, inflation gradually comes down, and they're able to just reduce interest rates in a slow, controlled way. I think the question is something going to shock the system? Maybe not this year, maybe not next year, but maybe the year after, or at any point in the next, call it 3 to 4 years, if they're just slowly kind of unrestricting economic policy. And that if anything does break, then we will return to kind of like the lower interest rate regime that we saw, through much of like from 2010 onward.
Mm-hmm. And so hard landing would be that basically we go into recession or into some kind of recession because I guess we had already done just too much damage to the economy based off all the rate increases, etc. Right? So soft landing, as you said, it just things stay as is, but they're being conscious of it staying as a soft landing. Because if they drop rates too quickly, by the way, I guess that's not even about a soft or a hard landing. Then we go back to inflationary problems. If they had held the rates high for too long and has these aftershock effects, as you said, maybe 3 years from now, and the hard landing is we're in recession. That's terrible for the economy. Although rates will go down again, but is that a good thing? Net, who knows?
Yeah. I mean, we're always kind of in that cycle, right? That's kind of the global cycle of things are in growth, and then they kind of fall down into some form of recession, and then they go back into growth. I mean, that cycle is kind of pervasive. And the central banks really can never see that happening until it's too late. Similarly with the pandemic, like stimulus that was given, and they held rates too low for too long. The fear here is that they hold rates too high for too long. So it's like that similar kind of, it's two bands. As soon as you kind of stretch those bands, they start kind of pulling you back to the center. So yeah,
super
a
helpful.
bit ethereal.
Andy,
We're getting a bit ethereal here. Yeah.
Putting it to practice, 5-year variable or 3-year fix. What are most of your clients doing? What do you recommend people consider when they make the trade-off?
Yeah, the spread is still pretty wide. The markets right now are still kind of factoring in 2 to 3 rate cuts this year. So we just had one. That means, the markets right now are forecasting maybe another 50 basis points off that variable today. Obviously we had that like great rate from TD, but since then
619,
I haven't
right, the
seen
promotion.
Yeah, I haven't seen a lot at prime less 1.
Which would now be 5.95, 6 point, it'd be 5.95 on a variable if we went, because prime is now it's 6.95. So just
yeah. So and then let's say they dropped another 50 basis points this year, so then you're at 5.45 on that. I think if you could get prime less 1 or greater, it would make sense for a
Mm-hmm.
variable rate right now and to start to take that bet. Um, you know, but if you're kind of like steady Eddie, you really don't want to like roll the dice. A 3-year fixed is an awesome option. I think given where yields are today after this meeting, and given probably where they're going to start to trend to over the next 60 days, we should see like 3-year fixed, probably like 5.1 or less. Um, I'm thinking. So,
Mm-hmm.
even with 2 rate cuts this year, putting it at 5.45 in like kind of the best scenario with prime less one, you're still ahead at the end of this year on a 3-year fixed.
Mm-hmm.
Um, that being said, you're still in that contract for another 3 years. Um, one thing that I've been trying to advocate to clients on a 3-year fixed is that the benefit of that 3-year fixed rate, or even say a 2-year fixed rate, is that in a year's time, if rates are quite a bit lower than they are today, you can blend and extend that mortgage out to 5 years and
Mm.
kind of capitalize on some of that like lower interest rate because you
Without a
don't have that
breakage
many
fee, hey?
months remaining. Yeah.
Without a breakage fee with most lenders?
With
Interesting.
yeah, with most
Talk to
definitely
your
with
broker
like
about
big
it.
bank. Yeah, talk to
Yeah.
your broker about it, but definitely with bigger bank lenders, monolines, it's a bit uh, yeah, like it's possible with most of them depending on the product.
Mm. Beautiful. That's a great thing for people to check. Can I blend and extend with you, Mr. or Mrs. Lender, based off a future rate decrease? What are on the fixed side? What are the nuances there? That's a great point, man. Andy, thanks for your time. This is super useful. I'm sure our realtor partners and our customers alike and our mortgage goers will really seek some great wisdom from this and put into action. Thanks again, man.
Thanks for having me.